41 up, so that's 0.4. And yeah, a little shy of 0.5% higher on the Sensex as well.
It's green all the way, pretty much the highest levels of the morning so far.
9,481 is where the index is at.
The market has soared for the second day running on the back of decent global cues.
The Nifty was up, of course, 170 points. So very strong follow through to yesterday's gains.
Dalal Street gains for the second straight day in line with global markets. Sensex Nifty gained 2% each, end at 1 month closing highs. The Nifty Bank continues its outperformance.
Metformin manufacturers Lupin, Sun Pharma and Aurobindo in focus. This, as reports suggest, that the US FDA found high levels of a cancer-causing substance in it.
TVS Motors and Ujjivan shine after good fourth quarter numbers, while United Spirits falls on weak fourth quarter results.
Consumer spending sees a recovery as the heat wave and COVID-19 influence consumer choices. Bajaj Electrical says demand for fans is higher, while Blue Star says overall demand is recovering. And
former World Bank chief economist Kaushik Basu calls for higher fiscal spending, ignoring rating agencies. He says the COVID narrative must change to highlight lower deaths in India and end lockdown intelligently. Well, those were the top 5 headlines from Dalal Street on a day when the markets clocked gains for a second day in a row, taking it to 1 month highs. Hello and welcome to Markets Today, the show where we will tell you about everything that happened in those 6 hours of trading in 5 headlines. I'm Latha Venkatesh, with me my colleague Surbhi Upadhyay.
Hi Latha. Well, lots of green on the screen. Maybe I am wearing the right color after all.
Absolutely.
Well, we've got lots of opinion coming your way on the show today, including words of advice coming in from Harsha Upadhyay of Kotak Mutual Fund. In corporate opinion, we get you a word from Dilip Sanghvi of Sun Pharma, Blue Star's B. Thiagarajan and Anuj Poddar of Bajaj Electricals. Former World Bank chief economist Kaushik Basu also joins in on the show with what he makes of the lockdown and the road ahead for the Indian economy. But before we get to all of that, let's dissect what was another very, very strong day for the market, Latha.
Oh, absolutely. I mean, for one thing, the global cues have been positive for the second straight day, and the global markets are able to ignore some very heated disagreement between China and the United States over the status of Hong Kong. In spite of it, they're able to push ahead. And of course, you find the logic. The logic is lockdown is ending. And therefore, irrespective of the unemployment numbers, the markets are rising everywhere. For India itself, there had to be short covering as well related to the F&O expiry. You're not able to roll over your shorts at a decent price and at a decent interest rate, and therefore it's best to cover the shorts, especially because of the ferocity of yesterday's rally. People would have been a little wary as well to leave shorts uncovered. As well, the volumes are slightly lower than they normally are because of the difficulties of getting to work, and that also exaggerates price moves. But there are 2 ways the markets can move now that you are nearing the end of the range. I mean, your 9,900 was the highest the markets have gone since the fall after the COVID scare. Now, as you reach closer, the markets will have to decide whether they want to continue to ignore macros or whether the fact that lockdown is relaxing and there is a lot of liquidity can keep propelling the bulls. But sooner or later, you will see the markets move. Take a call on this.
Oh, well, that's how it's playing out for now. Let's quickly boil this down to stocks and the trends of the day. Financials once again in top form, and we saw that on a lot of the banking stocks. In fact, let's pull up some of the main financials. HDFC Bank, actually the HDFC twins, even HDFC did really well for itself today. ICICI Bank, IndusInd Bank, it was pretty much a sea of green. SBI actually was the only outlier. Everything else was positive. What else worked well today? Autos are definitely in vogue, and two-wheelers stocks, they were really scorching the screens today. Look at that move on Eicher, 8.5% up. Hero Moto. TVS, by the way, came out with numbers that were more or less in line with expectations. Revenue was a little higher, actually. We'll tell you more about it on the show. That stock was up. Maruti saw some gains as well. Other gainers on the index included Z, which was soaring away. Not quite sure what's happening here, but a big move on Z coming in. L&T kept it good company. And then you had some consumer stocks, Britannia, Nestle, the taste of all things sweet. And the big boy itself, Reliance Industries pitched in. So lots of these heavyweights added to the market's gains. If I talk about the losers, very few stocks on the Nifty to talk about on the losing side today, and they're coming up for you on the screen. So that's about it. You can see cuts are not even 1% on the losers tally. Mid-caps, the good thing today was mid-caps came back and there was hectic buying. Some examples would be infrastructure stocks, because we are hearing that construction, at least in the green zones, is picking up. So NCC, IRB, these stocks were up and about. Motherson, Bharat Forge, these are auto companies, auto component companies with an overseas focus. So they were up and about. Voltas was up, so was BHEL. And EID Parry, that was a CNBC-TV18 exclusive, which Nimesh got us on prospects of reducing debt. That stock was up about 13% as well, Latha.
Oh, yes, that's a bunch of... Actually, even the advanced declines have done extremely well today, with 2.3 stocks in the green, for one in the red. So more broadly, I mean, the broader markets also have done well. So let's get you some expert opinion. Harsha Upadhyay of Kotak Mutual Fund spoke with us. He believes the markets have been euphoric, but it will take some time for the economy to recover. The markets are only smelling the recovery ahead of time. Here's what he had to say.
The markets have been euphoric and bearish at points of time. But I think rather than extrapolating what's happening in the market, it's better to isolate that and look at the business fundamentals. Clearly, some of the move that we have seen in the past couple of days has come because of the global cues and also some bit of short covering ahead of expiry today. The institutional participation has not been that great, apart from some of the large blocks that have happened in the recent times. So overall, we maintain our cautious optimism. But again, the focus has been to look for companies which will revive sooner than later and also survive this crisis and emerge stronger. We have not been looking to increase our exposure to financials at this point of time. But what we have done in the past couple of months is to consolidate our financial exposure into 3 or 4 large private sector banks, because we believe that the ability of these banks to survive this crisis is much higher than the rest of the financials. The capital situation is quite comfortable. Even in case of additional capital, if it is required, I think it will be available to these banks. The liability franchises are very, very strong. And also, some of these banks don't carry the baggage of bad asset quality of the previous cycle. So to an extent, I think they are much better placed today.
Okay, well, we want to highlight to you a related development that the markets did not concentrate. In a big global development that could impact geopolitics and markets in the coming days, China has moved to rein in Hong Kong despite a warning from the United States. Both nations are already at loggerheads over the origin of COVID and, of course, trade earlier. This is a new flashpoint. China's legislature has approved a plan to suppress subversion, secession, and seemingly any acts that might threaten national security. China is finalizing the rules which will determine how much of Hong Kong's autonomy will be preserved or how much Beijing will tighten its grip. US Secretary of State Mike Pompeo said last night that Hong Kong is no longer autonomous from China. That's a strong statement. So far, US tariffs on China do not apply on Hong Kong, thanks to a special law passed last year. Now, with this move from China, trade between US and Hong Kong could come under a cloud. Right, that's an important development which we will track for you in the coming days. Let's move to the second headline. Reports have said that the US Drug Authority has found high levels of cancer-causing substances in metformin. Now, what's metformin? It's a diabetes drug manufactured by companies like Lupin, Sun Pharma and Aurobindo Pharma. Ekta Batra is here with those details. Ekta, tell us.
Thanks, Latha, for that. Well, like you mentioned, currently there are reports that the US FDA has found elevated levels of cancer-causing substance NDMA in metformin, which is basically a diabetes drug. And recalls of metformin could be expected as early as this week in the US itself. Now, companies that manufacture it include Lupin. Estimates are around 7 to 9% contribution to their FY21 estimated EPS. and other companies include Aurobindo, Sun Pharma, Granules. In fact, we spoke to Granules and they have said that they received a notification from the US FDA yesterday on metformin itself saying that the batches are acceptable. And that's actually quite a large product for them. Around 28% of their total sales comprise of metformin, and majority of this is in fact supplied to the US in the form of final formulations. Now, we will have to see whether it would be company specific or what next steps the US FDA would take. But nonetheless, this is definitely a negative if in case there is any sort of concern which does come up in the future on this particular drug.
All right. Thank you, Ekta, very much for explaining that to us. So that's, of course, the news on metformin, which impacted those stocks. But there's more pharma news coming in. Sun Pharma came out with its fourth quarter numbers yesterday. The stock rose today close to 2% after the company said that it would be breaking away from the normal practice of giving guidance. We spoke with Dilip Shangvi, MD of Sun Pharma, who said that the company would revisit its stance on guidance in the next quarter.
As for the guidance, I wish we could give you a guidance. However, given the uncertainties in the near term, we are breaking from our normal practice of giving a guidance. We will revisit this stance in the next quarter. Our endeavor will be to gain market share in each of our business by doing better.
All right. And with that, let's move over to the third headline from the street. In earnings action, TVS, the stock, rallied 3% after the company reported an inline set of fourth quarter numbers. For more details, Sonia Shenoy joins us.
Well, thanks for that. TVS Motors numbers were slightly better than what the street was estimating. In fact, there was no negative surprise, and that's something the street will definitely like. The revenues were down about 20% because of a 30% decline that they saw in volumes on account of the lockdown. And there was a one-time loss of 32 crores that the company had to incur because of COVID-related expenses. However, what the street will like is the fact that realizations for them have gone up about 9.5% quarter on quarter, better than expected. So the realizations for TVS Motor have come in at 55,000 rupees a unit. That's because of a higher share of three-wheelers, the dollar appreciation and the price increases that the company had to take because of a transition to BS6 as well as the safety norms. The company also incurred a one-time cost of 22 crores for dealer discounts because of the transition to BS6. So weak numbers but no negative surprise, and good growth in realizations is something that the street will like.
All right. Okay, Sonia, thanks very much for that. Now, let's actually stay on with numbers. United Spirits reacted negatively. It was down almost 2% after the company reported a weak set of earnings for the fourth quarter with plenty of disruption in the 3 months for which it reported. Nupur is here with all the highlights.
Well, thank you for that. Weak numbers reported by the company. Management indicated that Q4 performance was largely impacted due to COVID-19 related disruption. And all in all, FY20 was a challenging year considering the general election in first quarter and slowdown in economy. On outlook, they indicated that the outlook for the next year remains challenging as well as uncertain. All in all, performance was below expectation. Revenue was down 11%. Gross margin fell by around 400 basis points to 42%. Profit was down by around 76%, but operating margins came in line at 13.6% versus expectation of 13% on lower employee cost as well as other expenses. Volumes were down by around 13.3% versus expectation of 8 to 9% decline, and under prestige and above segment, volumes were down by around 20%. This segment contributes over 60% to their top line, but from balance sheet, company managed to repay debt by around 600 crores. It came in at just 2,000 crores versus 2,600 crores same period last year. But do remember, stock trades a slight discount when compared to its peer at just 33 times FY22 expected earnings.
So that's how United Spirits did. I mean, the stock 2.5% lower. But we're not done with numbers, so brace yourself. There was a lot of earnings action. Two banks actually, Ujjivan and Federal Bank, came out with numbers. So quickly, Abhishek Kothari, tell us all the details.
Well, for Ujjivan, Latha, the lower cost of funds and decline in OPEX actually aided their operating profit growth. However, sharp increase in provisions dented the earnings momentum. So NII was up 8.5% sequentially, OPEX down 4.5% quarter-on-quarter, which meant that operating profit growth was north of 40% plus. However, provisions tripled, and that is why you saw the PAT growth of just 3.3% quarter-on-quarter. For Federal Bank, 35% of the book are under moratorium. Slippages declined massively to 284 crore when compared to 593 crore in the previous quarter. Asset quality improved. If you take into account the moratorium, asset quality would have deteriorated a bit. Business growth remained on the lower side in last 4 years. However, declining trend of net interest margin has been arrested, and low cost deposit ratio that is at 5-year low of 30.5%. Back to you.
Yes, sir. Well, be that as it may, Abhishek, you will have to admit that the market is pleased that it is only 35% under moratorium, or maybe Federal Bank was just the beneficiary of a general pro-bank sentiment that we have seen over the last 48 hours. Yep.
Those stocks also joining the party, joining the rally that we've seen in financials today. We'll take a break on that note. On the other side, we come back and get you more headlines from today's action. Welcome back. You're with us on Markets Today. Let's move to the fourth headline of the day. Consumer companies believe that consumer spending is on the road to recovery owing to the ongoing heat wave and the pandemic. Bajaj Electricals' Anuj Poddar says that the demand for fans is higher, while Blue Star's MD B. Thiagarajan maintains that overall demand is actually recovering quite well.
For the past 2 weeks, the sales have been good. Quite a few markets have opened. We are present in about 6,000 stores. As of now, 3,500 stores are open. Of course, there are odd even up to 2 p.m. Some shops are open. Some shops are open alternate days. But the good news is the demand is excellent.
Firstly, fans, as I just repeat, is seeing the highest sales for us. I think that is aided by the season right now, heat and summer. But the kitchen appliances actually are doing fairly well for us, or actually really well for us. We are in the very low ticket price, very essential, products. As I always tell our teams, if a person's, cooker or toaster or iron or bulb or fan is not working, they don't wait and they don't postpone those purchases. More specifically to your question, I think the lockdown in a way has brought back the love of cooking. More and more people are engaged in eating at home, cooking meals together as a family exercise, not necessarily relying on staff to do that, but doing it by themselves. And I think that, bodes well for the level of engagement that people have with the, cooking appliances.
Okay, so that was an encouraging conversation. And with that, we come to the fifth and the last headline from Dalal Street. Former IMF economist Kaushik Basu told us, sorry, it's not IMF, former World Bank chief economist Kaushik Basu told us that India needs at least a 3% of GDP fiscal support to get out of the COVID-related recession. In a conversation with us, he's also called for an intelligent exit strategy from the current lockdown on the argument that, of course, getting back to work is itself a stimulus. Listen.
I do worry about India's inequality. And I have been in favor that you have to tax the rich more and transfer money. But now in the middle of this is not the time. The interest of the poorest people actually are intertwined with the big corporations. If the big corporations begin to do badly, the big firms begin to do badly, the supply chains go all the way. It's going to hit the poor. Within weeks, the poor will be hit. So yes, absolutely right. That the government has to worry immediately right now about the migrants and the poor, but within weeks, 2 weeks, a fortnight, about even the bigger companies. So, because you cannot allow that to go down because it's all intertwined, and the big corrections that the economy needs, those things can wait a little bit. The structure of the recession is changing in India. See, in the beginning, it was a pandemic-induced recession, which is very different from a conventional recession. Some sectors feel shortage of supply, some feel a shortage of demand. I feel we are today in India where it's almost a helicopter drop kind of support from the central bank that is needed, where cash is made available, but the main responsibility is fiscal. And that is what I think everyone is reacting. We are not taking on enough of the fiscal responsibility. 1% additional fiscal responsibility of GDP is not good enough. My own calculation was 3% fiscal, so 3 times what we are doing. This has to be done very, very urgently. The COVID incidence is continuing to rise in India. The lockdown is not being as effective as it has been in other countries. But something that has to be kept in mind, which is not being pointed out enough by international spokespeople. If you look at number of people who are dying by COVID deaths, I feel that's more important to look at than the incidence of COVID. If you take a per million population number of people who have died by COVID, I'll give you two numbers. United States is 311 people per million died. In India, it is 3. So India, the COVID fatality, or what is called the crude mortality rate, is actually much lower.
Okay, this is important. One of India's finest economists saying that we need to recognize that the fatalities in India are not anywhere as high as any other country, and therefore to come out of lockdown.
That's the big silver lining we all need to hold on to, Latha, right? Absolutely, as Kaushik Basu points out. Well, let's move on to another story that we have. As the economic restart picks up momentum around the world, CNBC-TV18 spoke with the top Indian IT services companies to understand if IT spending is returning anytime soon. Kritika Saxena is here with those details. Kritika, what did you find out?
Well, Gartner had cut IT spending for the coming year by 8%. We've been speaking to our sources in the top IT companies in India. What we understand is that the biggest hit is going to be in retail, travel, transport, hospitality, and banking and financial services. US is expected to cut the IT spend the most, followed by UK and then rest of Europe. Now, banking and financial services, according to our sources, are even seeing massive pause in discretionary spending or significant cuts for the coming year. Manufacturing may see some amount of revival, but only once things pick up. So only in second half we could see some kind of movement. Now, as far as client pricing is concerned, clients are seeking discount of up to 30 to 40%. So pricing will be hit. Clients in retail, transport, travel have sought furloughs of 3 more months. So that's basically leave without pay for employees that are working for these clients. And they are insisting, at least in the banking financial services, that work from home component reduce substantially in that particular category. Now, what are companies doing about this? Subcontracting costs have already been cut by 70 to 80% already. And we understand that employees on bench have been asked to take furloughs till their contracts can be rechecked. So a lot of cost-cutting measures being put in place to be able to contain this.
That point was taken. The markets also did see a bit of softness on the IT stocks, as you must have noticed, Kritika. Well, with that, we wrap up on markets today.
Absolutely. Penultimate day of the week done. Tomorrow morning, Friday, we'll be back bright and early with all the market action. For now, from the entire Markets Today team, it's a wrap.